Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next 20 minutes or so talking to you about the COVID-19 pandemic and the impact that it's having on the global economy and investment markets. I'd also like to share some thoughts with you about Adviceworx' view on the current investment climate and prospects for the rest of the year. This week saw scenes reminiscent of the Cold War era over the Black Sea and the Strait of Taiwan, as Russia and China flexed their military muscles against NATO and its allies. Russia dropped bombs and fired warning shots at a Royal Navy warship which it claims had entered its territorial waters off the Crimean Peninsula. NATO maintains that the area belongs to Ukraine, a NATO ally. Meanwhile, Taiwanese F-16 fighters were kept busy driving Chinese Harpoon bombers out of its airspace. China has staged frequent and ever larger incursions into Taiwan's airspace in recent months and maintains that it has sovereignty over the island, which it regards as a rebel province. By Friday night, more than 181 million people had tested positive for COVID-19 worldwide, and nearly 4 million people had succumbed to the disease. The United States remains hardest hit, with 34.5 million infections and more than 619,000 deaths. India, Brazil, France, and Turkey still make up the rest of the top 5, and South Africa remains in 19th position in terms of the most recorded cases. There was a slight increase in new COVID-19 cases this week. 15,000 more cases were reported than the week before, an increase of just under 1%. India and Argentina enjoyed double-digit declines, while new case numbers in Brazil and Colombia were only marginally higher. The big countries which experienced the sharpest rises in new infections were Bangladesh, Indonesia, Russia, and South Africa. Europe seems to have flattened the curve, but there are worrying signs that Africa is about to become the new epicenter of the pandemic. The weekly global death toll fell by 1,600 or 3% this week, with India, Brazil, and Iran making the most progress. Indonesia, Russia, and South Africa fared the worst, while Bangladesh and Iraq also suffered significant rises in COVID fatalities. While 6 of the 10 hardest hit countries are currently in the Americas, this should change over the coming weeks as Asia and Africa suffer a larger proportion of new infections. By Friday night, 2.8 billion doses of vaccine had been administered worldwide, and 1.76 billion people, or 22.6% of the world's population, had received at least one dose of vaccine. More than 41 million doses are currently being administered per day, with China, the United States, and India leading the way. Based on a number of assumptions, around 1.4 billion people, or 18% of the global population, are now fully vaccinated, with China, the United States, and India also in the first 3 positions. The biggest concern on the vaccine front is that less than 1% of people in low-income countries have received at least one dose. US President Joe Biden has finally secured some Republican support for a part of his ambitious infrastructure plan, and America, the Eurozone, and Britain all experienced higher consumer inflation in May. Business confidence in Germany is at its highest level in nearly 3 years, and US manufactured goods orders rose, but by less than expected. British factories produced much more than a year ago in May, while China is steadily tightening the screws on the pro-democracy movement in Hong Kong. According to the minutes of its June meeting, the US Federal Reserve now envisages higher GDP growth and consumer inflation than in March, but is not overly concerned about the US economy overheating. The Fed predicts GDP growth of 7% this year, which will recede over the next 2 years. a gradual decline in unemployment, and inflation peaking this year and then gradually reverting to its long-term average. As a consequence, it does not foresee a need to raise interest rates before 2023, when, unlike at its March meeting, it now expects having to hike short-term rates by 50 basis points. Despite promises of better days to come by Brexiteers, Brexit has thus far produced mainly negative outcomes for the United Kingdom. As the top graph shows, the British pound has weakened over the past 5 years by 6.25% against the dollar, 10.1% against the euro, and 7.6% against the rand. Over the same period, the FTSE 100 has risen by a mere 11.9%, while the S&P 500 has more than doubled, and the Euro Stoxx 600 has risen by nearly 3 times as much as the FTSE. Global equity markets were back on the front foot this week, while bond markets and the US dollar softened. Oil and coal continued to advance despite Chinese efforts to squeeze out speculators, and Amazon is under fire for undercutting specialist logistics firms using its economies of scale. And finally, the market seems to love Nike's foray into vegan sneakers. All major equity indices ended the week in the green, with the Russell 2000 the week's best performer. China's A50 lagged its Taiwanese competitor over 1 month and the CAC 40 for the year to date. Longer term, the FTSE remains the wooden spoonist, with the Russell 2000 ahead over 1 year and the Nasdaq over 3 years. A more optimistic mood on markets combined with a slightly weaker dollar and supply constraints to push commodity prices higher this week. After a couple of poor weeks, nickel rose sharply, along with platinum group metals. Iron ore slumped, however. Coal and oil stayed in the hunt and remained the two top performers over the past month, with platinum bringing up the rear. A good week saw lithium extend its lead for the year to date, while gold remains in the red. Last week, the Portuguese soccer legend Cristiano Ronaldo caused a drop of 4 billion rand in the market capitalization of Coca-Cola. Coke is one of the main sponsors of the European Football Championships, and bottles of their product are prominently displayed at media conferences. When he was interviewed after Portugal's win over Hungary, Ronaldo, who is an advocate of healthy living, removed the 2 bottles of Coke on display and drank mineral water instead. When the market opened the following Monday, the Coca-Cola share price fell by 74 cents per share, or 1.4%, which wiped $4 billion off the share's value. We remain positive about global equities. Corporate earnings continue to grow in the current low interest rate environment. US price-to-earnings ratios are looking stretched, but equity earnings yields remain more attractive than bond yields. Pan-Europe offers better value, but the most attractive valuations are to be found in Japan and emerging markets, including China. We are, however, keeping an eye on what happens to inflation and interest rates and will react if they take a turn for the worse. For now, we remain underweight global bonds as yields remain unattractive, and if mandated to invest in bonds, we prefer emerging market bonds over those of developed markets. We retain a neutral weighting with regard to global property. Our least favored sectors are retail and office property because e-commerce and work from home could do long-term damage to their profitability. Conversely, these two trends are positive for the industrial and residential property sectors. The hospitality sector should recover in due course, but only once vaccinations have achieved critical mass. Here at home, the Department of Minerals and Energy's controversial plan to charter 3 so-called power ships to provide the electricity grid with power over the next 20 years was derailed. The Department of Environment, Forestry and Fisheries refused to authorize the transaction, citing an unsatisfactory environmental impact assessment. There are also reports that the Green Scorpions are investigating the legality of how the contract was awarded to the Turkish car power ship consortium. Car power ship have announced that they will appeal the ruling, however, and they have powerful allies in government, including the Minister of Minerals and Energy, Gwede Mantashe. By Friday night, nearly 1.9 million South Africans had tested positive for COVID-19, with just under 19,000 new cases on Friday alone. More than half of all active cases and hospitalizations are currently in Gauteng, where the third wave is rapidly overwhelming the health system. 215 people died of COVID on Friday, which brings the death toll to date to 59,621. Government started vaccinating teachers this week, and thus far 2.7 million people have received at least one dose of vaccine. President Ramaphosa is due to address the nation on Sunday night, and it is widely expected that the country will be placed on a level 5 lockdown footing in the coming days. Headline consumer price inflation rose sharply in May, but with core inflation still very low, there is reason to hope that this will be a temporary phenomenon. The fuel price was steady, but food and non-alcoholic beverage prices rose sharply. Producer price inflation also surged, but this was largely due to rising input costs in the mining sector. The fuel price is a cause for concern, since the dollar price of oil keeps rising and the rand has weakened against the dollar. Local government finances are a shambles, and corruption is emptying the public purse. And finally, thanks to COVID, finding a seat on the Gautrain has become easier. Over the past 5 years, South Africans have become used to low inflation and correspondingly low interest rates. Last year's CPI even fell to below the Reserve Bank's target band of 3 to 6% in the second quarter. Since then, headline inflation has risen sharply. While concerning, the headline number is distorted by the impact of volatile items like fuel and food. These prices are functions of global demand, which is surging. Local demand for other items remains weak, which is borne out by core inflation of only 3.1% in May. Economists believe that headline CPI is about to peak as the year-on-year base is rising and should decline to around 4% in the second half of the year. The Reserve Bank predicts an average CPI rate of 3.6% for next year. One of the key drivers of inflation is the price of food. For many households, it is the largest single item on the monthly budget. Sadly for the poorer segment of society, many of the food items whose prices have risen the most over the past year are not luxuries, but staples like cooking oil, dried beans, stewing beef, sweet potatoes, cereals, and chicken. Thanks to bumper harvest locally and softer global prices, relief might hopefully be on its way. This graph offers an interesting insight into how the pandemic and the associated lockdowns have affected South African spending patterns. Between March 2020 and March this year, food prices rose sharply because we all have to eat even if food costs more. Clothing and footwear are subject to far more demand flexibility, and retailers had very little pricing power. Recreational equipment and alcohol and tobacco were inversely correlated. When a lockdown was enforced, demand for the former rose and the latter fell, and vice versa. Vehicle sales dropped off initially and then normalized. On the JSE, the all-share index ended the week marginally higher. The resources sector benefited from higher commodity prices and a weaker rand, and the financial index was lifted by a sharp rise in Old Mutual's share price. Naspers and Prosus weighed on the industrial index despite pleasing results. The bond market ended weaker, and our mining houses have ambitious expansion plans. Despite previous misfortunes in Nigeria, MTN is investing heavily in its data network there, and Old Mutual divested itself of most of its remaining interest in Nedbank. Last week's talk of higher inflation and interest rates saw a strengthening of the US dollar and foreign investors losing their appetite for emerging market securities. Both the JSE and the bond exchange saw significant outflows of 6.6 billion and 5.1 billion rand respectively, and for the year to date, the JSE has seen foreign selling of 26.7 billion rand and the bond market 36.75 billion. A stronger dollar is almost invariably bad news for emerging market currencies. There was a strong surge in capital flows into the United States after the Federal Reserve's interest rate remarks. This caused most emerging market currencies to depreciate against the dollar, and the rand traded at 14.23 rand to the dollar on Monday. Since then, it has regained some lost ground, however, and it ended the week at 14.14 rand per dollar. Platinum group metals have largely overtaken gold as South Africa's premier precious metals. South Africa produces more than half of the world's current annual supply, with platinum representing 58% of production, palladium 34%, and rhodium 8%. Palladium and rhodium are mainly used to make catalytic converters, but are also found in medical and dentistry equipment, watches, and aircraft components. Platinum itself is used in a variety of other ways, especially in jewelry and as a dollar hedge investment. We remain slightly underweight South African equities relative to our long-term strategic asset allocation. Domestic equities look cheap relative to offshore equities, both in developed markets and emerging markets, as well as relative to the JSE's own historical average price-to-earnings ratio. Despite the apparent value they offer, local equities remain hamstrung by the weak domestic economy and uncertainty over government's economic policy intentions. Despite the sharp recovery in the prices of some domestic listed property counters, we remain worried over the sector's long-term outlook and heavy debt burden. We therefore avoid property until the outlook changes materially. Domestic bonds remain our preferred local asset class. Yields remain highly attractive, and although we remain concerned over the long-term outlook for South Africa's government finances, we believe that a substantial risk premium is already factored into bond prices and yields. We prefer government inflation-linked bonds at the shorter end of the yield curve and nominal bonds higher up the curve. We are wary of corporate credit, however. It looks both risky and expensive. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make at least some sense of it. Should you have any further queries or questions, please don't hesitate to contact me or your Adviceworx financial advisor. All the best for the week ahead. Goodbye from me.